Yeah, in the studio in Johannesburg is Mike Esmond, the CEO of NFP Financial Services, as always on a Monday. It's Strategic Thinking. Last time we spoke, Mike, you were talking about the bonds, and you were saying that maybe bonds are not such a safe haven. But since the developments of last week, the South African bonds and also the South African rand have rallied hard. Okay, they're coming off a little bit at the moment. But what did you make of it? Did it change your strategic thinking towards the bond market after Mr. Bernanke last week?
Not at all, Lindsay. The point really amplified by our last discussion is that the market is so vulnerable. It's almost like it's on a steroid high, where whatever happens is a reflection of what people are saying and of mood and an underlying need to try and get some return. So, you know, when Mr. Bernanke announced that there was a strong chance that they would look at a more cautious, at a more sort of a hawkish take on QE and slow down their financing of debt, to last week reversing that position, you see an incredible change in bond yields. Now, what worries me is that central banks, ours and other, are really there as moderators of what goes on and are supposed to let the man in the street sleep easy at night. Now, anything but that is taking place right now. So what we've done at a tactical level is we've been climbing in to 5-year guarantees, because the insurers offer a thing called an annuity, which pays you quite an efficient after-tax return. Those rates have been up to 7.5%, almost 8% in the last few weeks, which tax-free translates to 3-4 times what you could earn on call interest after tax. So the bond market is all over the show. The trend it's not a 1 month, 3 month, 6 month trend. It's a 5-year trend. And if interest rates trend anywhere in the next 5 years, my guess would be upward. And that means that if a long-term debt is issued and you purchase it at these levels currently, you probably are not going to be in a very, very positive position over that period.
What does this mean for equities? Because one of the key points over the last 2 or 3 days that I've read is that 3 very influential investors, all of whom are multi-billionaires, have come out and said, you know what, we've been big fans of Mr. Bernanke and we've been big fans of the stock market, but we can't find any value out there. And they're talking mainly, I think, about the US stock market. The most notable of those 3 billionaires is Warren E. Buffett, who has said, yeah, we can't find anything. And he's been a fan of Bernanke. He said this man's a hero and he should actually stay in the job. But he can't find value in the stock market, so maybe it's all over.
Well, it's never all over. I think that Mr. Buffett won't be buying necessarily because he can't find deep value, which is a tenet of what he does, is he looks for things that are stressed for good reasons, where it's not a bank or a financial services or a building or a railroad business that's going to the wall, but rather one that for one or other extraordinary reason, which could be legislative, could be economic, could be emotionally driven, is out of favor as he goes after those. Right now, there's so much money that could either earn nothing in the bank or chase after some idea of growth or dividend or what happened last month. And that's exactly what's been going on. So Buffett's not disinvesting. He's not simply putting the enormous flows that Berkshire Hathaway get in every month from dividends and new investments into what he deems as overpriced assets.
Does the dividend story also start to taper? That's a word that we keep on using. Does it start to taper now? Because if interest rates are going to rise, and you're suggesting that they will, that'll be the next move, then dividends don't become as attractive as they were. Do you think it's all over for that one?
No. I think that what good companies and great companies do is that they're able to deal with the factors that influence the economy. Monetary policy changes interest rates. Monetary policy is the central bank and the government's mechanism to try and manage and flatten out the strong peaks and troughs which would otherwise characterize markets. The sort of boom and busts must be avoided. So the central bank plays with instruments like debt, the issuance of reserve bank treasury bills or bonds, the repurchase or not repurchasing those assets is how they manage that show. But that typically goes up and then down in 5-year cycles, sometimes a bit longer. The Equity story is a well-run company that grows earnings, can retain the ability to grow dividends. And you might invest right now, and it might only pay you a 3% dividend right now. But if that company does grow earnings at a reasonable lick over the next 10 years, look back 10 years later, and you might find that on those SAB shares that are quite expensive right now, that you were earning 3%. If you look at the current dividend, you're probably earning 10% of the money you placed 10 years ago. That is interesting, and that is where growth comes from. And the dividends in any long-term phase of the equity market are a critical contributor, because if you don't spend them, you can reinvest them into the more volatile actual share price.
So what you're saying is that despite what happened last week, which I thought was quite a monumental event, there is no change. The end of sort of a 4 or 5 year era of investing, whether it be equities, currencies, emerging market currencies, bonds in whatever jurisdiction, it's all going to just carry on.
It will carry on, but it's not a time. If you look at the heavyweight industrials in South Africa, you look at companies like Brewers, you look at companies like some of the healthcare, some of the financials even, is they are in expensive territory. So what the market doesn't offer is any form of guarantee. It's written all over that can. So in order to try and mitigate that, it's not to go flying in there where your friends tell you at dinner how well they've done on their SAB shares. It's to in fact say, hang on, have I got the appetite? Have I got the time? And can I afford to invest into something which in 20 years will give me the best return of all of the asset classes? But in the near term, in the 1-3 year period, even 5 years perhaps, it could be very, very nerve-wracking. It's kind of a roller coaster type of a risk that one is taking to invest all the proceeds of your retirement, the sale proceeds of your business. To go in there gung-ho right now would be dangerous.
Mike, we'll have to leave it there, but thanks very much for your time this lunchtime.